This video is an Uncovered Japan Company research report on Double Standard, ticker 3925. It is a small Japanese data processing specialist with unusually high margins and a fortress balance sheet. But it is also rebuilding after the loss of a major customer exposed just how concentrated its revenue had become. The starting point is a sharp contrast. Double Standard still earned a 24.6% operating margin in fiscal 2026, held 5.3 billion yen of cash, and paid a 5.8% dividend yield. Yet its forward PE was only 13.7 times. The discount reflects the market's doubt about whether new work can replace the revenue that has rolled off. The product is more concrete than the label data cleansing suggests. Double Standard turns inconsistent addresses, scanned forms, and fragmented customer records into precise, structured data. Its tools include address normalization, OCR, identity resolution, and electronic Know Your Customer workflows. Those functions matter in finance, real estate, e-commerce, and local government, where a bad match can create a real operational or compliance problem. The earnings reset was severe. Fiscal 2026 revenue fell 12.4% to about 7 billion yen, but operating profit fell 33.9% to 1.7 billion yen. The key reason was the loss of high-margin Daiwa Living work. Revenue disappeared, while the underlying people, systems, and processing capacity did not shrink much, so profit fell much faster than sales. The balance sheet is the central counterweight to that operating shock. At the fiscal year end, Double Standard held 5.287 billion yen of cash and deposits, had no interest-bearing debt, and an equity ratio of 90.5%. Return on equity has normalized as earnings fell and cash accumulated, but at 17%, it remains solid. This financial flexibility buys time for a careful recovery. Income is another important part of the case. The company raised its fiscal 2026 dividend to 70 yen, producing a 5.8% yield when the report was prepared, while close-listed data and AI peers paid no dividend. But the payout ratio climbed to 85.4% after earnings fell. The cash balance supports the near-term dividend, while its durability ultimately depends on restoring earnings. Fiscal 2026 operating cash flow fell to 775 million yen. But the report identifies an important timing effect. The company paid 876 million yen of tax, tied to the prior, higher profit year, just as current earnings weakened. This is also a light capex business. Investing cash flow was only negative 24 million yen. The cash flow dip should not be read as proof that the operating model has broken. The same feature explains both the historical margin and the risk. High-precision algorithms embedded deeply in a customer's workflow are difficult to replace, creating switching costs and recurring maintenance revenue. But the company allowed a few relationships to become too large. Its top two customers represented 75.6% of sales. When Daiwa Living Systems migrated, the deep relationship became a sharp earnings cliff. The strategic upside rests heavily on SBI. SBI Financial Services took an approximately 20% stake in September 2025, and Double Standard's identity verification, OCR, and data processing tools are relevant across financial and non-financial workflows. If SBI introductions turn into diversified customer wins, they could address both revenue recovery and concentration. That remains unproven, and management has not disclosed a numeric midterm plan. Valuation shows what the market is demanding. Double Standard's forward PE fell from a 37.5 times peak in fiscal 2021 to 13.7 times, below the report's 5-year average and about 67% of the sector median. The discount is not mysterious. Investors see a high-margin, cash-rich business, but one whose growth, customer diversification, and AI positioning still need to be demonstrated. The report's author-built 3-year scenarios make the asymmetry explicit. The base case assumes new work gradually replaces the lost revenue and values fiscal 2029 earnings at 13 times, implying about 18% price upside before dividends. The bull case requires successful SBI conversion and stronger core growth. The bear case assumes the residual Daiwa runoff outruns new wins, producing roughly 45% downside. These are estimates, not forecasts or recommendations. Double Standard combines a genuinely capable precision data franchise, a net cash balance sheet, and unusual income with a difficult recovery challenge. The variables to watch are concrete: new client wins, any SBI-linked commercial disclosure, gross and operating margins, the pace of the Daiwa runoff, and dividend coverage. This is a research framework for following the evidence, not an investment recommendation. For a much deeper look, visit the free deep dives at uncoveredjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security. Always do your own research.